Another check in the markets today. Stocks falling hard as COVID protests in China weigh on the markets. The Dow dropping nearly 500 points. The S&P and Nasdaq both falling more than 1.5%. The spread between 2- and 10-year treasuries narrowing slightly after crossing the 80 basis point level earlier in the day, a fresh 40-year low. But there were some bright spots in this sea of red. Ulta and Merck both hitting all-time highs during the session. Meantime, Black Friday sales scored a win for retailers, at least on the surface. Online sales a day after Thanksgiving topping $9.1 billion. That's a record, according to Adobe Analytics. But what's that number look like when you account for inflation? Let's bring in Joe Lavorgna of SMBC Nikko Securities America. He's also the former National Economic Council chief economist. So, Joe, we were talking about this. We're like, oh, on the surface, all the headlines are cheery. The consumer's still strong. Well, when you think about what inflation has done to prices and you think about mentally backing that out, it would seem to me that there should be a decline. Yes.
Well, look, the nominal numbers look OK because the prices are higher. So the units times the higher prices gives you good nominal numbers, the $9 billion. And it may turn out that November consumer spending looks great. And November 2007 looked good. And December 2007 looked good. And it turned out that that was the peak. The economy entered recession in January. There are three factors that are going to hurt consumer spending going forward. Certainly one is higher rates. Change in interest rates has been the largest in 25, 30 years. You look at mortgage rates. Secondly, you still have very high food and energy costs. Headline inflation is running above wage growth. And the third piece, which is important, is wealth. Households are losing in the stock market, they're losing in the bond market, and their home prices are slowing. All three of those factors, Melissa, suggest to me that the economy is going to be a lot weaker next year.
What we started to hear from retailers also was less of a use on the part of the consumer of debit and cash and more on credit at a time when obviously the rates on credit cards are they're through the roof before, but now even more so. I'm wondering how you factor that in terms of viewing the consumer's health as they lever up in a time when rates are rising still.
Well, they're levering up in part because the average consumer's real wage is declining, and credit cards are an easy way to fund sort of a lifestyle change. People want to get back to normal. I was happy to come into the studio. Hadn't been a long time. Everything has been remote. And people are still, I think of that excess, the vestiges of that excess demand are still there. But at some point, if the economy weakens as I expect and the labor market slows, you'll see credit card debt go up higher as people try to fund that spending a bit longer. But eventually it'll turn down. And the fact that there's been so much debt usage, to me, is a problem. It's not a sign of health.
Yeah, Joe, I appreciate, obviously, you coming on. $5 trillion now consumer debt approaching, if not through it. North of $1 trillion in credit card debt in the United States. I mean, these are astronomical numbers that you still have people come on and talk about the health of the U.S. consumer. What's the disconnect there?
I don't think there's the disconnect so much, Guy. I think that, again, we were coming out of a pandemic, and all the lags and the normal relationships have been askew. But I don't see how the consumer, given what I laid out, is going to be able to sustain these rates. If you look at household net wealth through the second quarter, the Fed's data show over a $6 trillion decline in household net wealth. So you have $6 trillion decline in net wealth, $5 trillion in debt. I think the issue, Guy, is that the spending is contemporaneous. It tells you kind of where you are now. It's not forward-looking. If you look at things like consumer sentiment, expectations, which are in the index of leading indicators, those are at recessionary levels. So the question is, how bad is the downturn, not whether we're going to have one.
So, Joe, let me ask you, okay, except we're going into a slower economy, what do you think is going to happen to credit quality? Obviously, it gets worse, but how much worse do you think it gets?
I would just correct you, Karen, and say it's going to be a contracting economy, not like we had in the first half of the year, where the contracting economy where we lose jobs and the unemployment rate goes up. If we look at this Fed Senior Loan Officer survey, we're seeing banks starting to tighten lending standards, both to on the commercial industrial side, the commercial real estate side, and households. So it could get a lot worse. It kind of depends, one, on what happens with food and energy. Do those come down? That will lower inflation. It will add liquidity into the system. It's like a tax cut. That'll help because the Fed then can ease rates as consumers feel more flush. And then what's the Fed's response? Do they actually continue to raise rates and then, importantly, keep rates at a restrictive level? My view is they won't. Jay Powell will flinch. When the labor market weakens, I think they'll fold and fold pretty quickly. If they do, you may have higher long-term inflation, but that'll help at risk assets, especially on the credit side. Because right now, Karen, we're pulling a significant amount of liquidity out of the market. The balance sheet unwind has just started. the correlation on a change basis between the S&P and the balance sheet is about 94. And right now, based on liquidity trends, S&Ps have not hit their low for the cycle. So to me, there's a lot still that has to come through the system. And as that happens, credit trends will get worse because, as you know, credit and equities tend to be interconnected. What's the magic number in your view where Jay Powell flinches? When we start to lose 150, 200,000 jobs a month, when there is, this is a weird way to put it, when there's confidence or concern, rather, the unemployment rate is going to go to 5 and possibly higher. And that could happen with the rate in the low 4s if the job numbers start to show a couple 100,000 loss a month. All right. Joe, good to see you in person. Thank you for having me. Thank you, everybody. Joe Lavorgna. What do you think?
It seems like that's the number. It's the unemployment number. It's the last piece of this whole puzzle. Joe just talked about how we've seen risk assets come down as rates have gone up, what negative wealth effect that's happened here. And I think we're all sitting here waiting. Listen, there is a silver lining scenario where maybe the recession is not that deep and maybe unemployment doesn't go up meaningfully because of some of the issues that we've been dealing with for a while. And immigration is a big part of it. So maybe it is different this time as it relates to the unemployment. But it seems like very likely, he seems very convicted that we are going to see a contraction. So recession is going to come. It just depends how bad it is and when do risk assets, specifically stocks, start to discount that.
Yeah, Jeff, how did you feel when you saw those Black Friday, Cyber Monday numbers start rolling in? Were you happy that the consumer seemed strong, or did you raise your eyebrow?
It's been an eyebrow raiser, and we've talked about this time and time again. It's the less stuff at higher prices story. You see it all over the place. We looked at a chart related to this months ago, and it looked at nominal sales that were trending higher and real sales that were flat. And now you can see really specific examples of it. You know, Pepsi, I think, is a great example. Overall food and beverage market, you've seen about 14% price hikes. What's Pepsi's revenue growth? About 15%. You see the same thing in Clorox. You even see it in names like Amazon. So I still think you are seeing the less stuff at higher prices, and that's what's driving some of these numbers. And that's why I continue to favor some of the discount retailers. I know we're going to talk about Dollar Gen in a second, but that's where I am on the whole consumer story.